Okay, we've got 8:31, so why don't we go ahead and get started? I think everyone's here. It's going to be here. We got Leanne and Lorena on the video here. We can't make it. Leland cannot make it, and so we're all here. First order of business is approval of the minutes from our January meeting. I'll move it. Second.
Second.
Any discussion? All those in favor?
Aye.
Okay, and over to you, Janet.
Thank you. Good morning, everyone. For our February 1st pension gross payroll for the town PD and Board of Ed, we had 100 retirees. Gross payroll was $165,938. Craig Stone was added and he was paid for both January and February benefits. So the March 1st gross payroll will be a little less. We have one QRDO spouse for a total of 101 participants. For the fire department, we have 37 retirees, gross payroll of $16,502. 6 members received an annual increase for the extra year of service earned in 2024. So there was a little bump in the gross payroll for February 1st. For the fire department, we have a QDRO spouse with 38 total participants. For our pending retirements, all 3 of our pending retirements are for the fire department. Michael O'Neill will retire April 1st with 22 years of service. Rob Vanderhorst will retire June 1st with 10 years of service. And past chief Vernon Scow will retire, has applied for an early retirement for June 1st with 28 years of service. For our current defined benefit and defined contribution plan, active employees as of February 14th payroll, the defined benefit pension plan has 45 contributing town employees. We do have 2 police trainees who are not yet contributing. The Board of Ed has 20 contributing employees. Our defined contribution retirement plan has 43 town employees and 29 Board of Ed employees. And 75% of those employees are electing the optional match. And of that, 86 are the town employees and 59% are the Board of Ed employees.
Questions, comments? Pending retirements. Vanderhorst, he was a policeman also, right?
Yes.
Do we have many that have both fire and police? I mean, this doesn't really matter that much, but.
Currently, we have 3. I want to.
So are a few.
Yeah.
Yes.
Yeah.
Okay. Okay. Any questions, comments? Anything? Yeah. Okay. Kevin, turn over to you.
Great, thank you. Both market perspectives, we'll start with that.
Oh, may I add just one thing?
Sure.
I just learned yesterday, this will be on our reports for next month. I just learned it yesterday that we did have a retiree who passed away.
Okay.
So I'm going to page 3. So there's an article actually that just came out this morning on Bloomberg talking about how the Trump rally has kind of stalled here. And if you kind of see on the left-hand side, you can see that the NASDAQ and the S&P have kind of been range bound basically since the beginning of December. Same with the 10-year US Treasury yield, which is like down to like 4.55 today. So some of the, I'd say optimism or, what we thought Trump's agenda was going to be is sort of, in a wait and see mode, right? And some of the things you'll see as we kind of get through the report are going to be a little bit surprising, I think, especially for this committee, given, what we thought US exceptionalism was going to be, because a lot of asset classes that you wouldn't think are doing well are actually doing pretty well to start the year. Do you want to go to page 10? You kind of see on the right-hand side, year-to-date performance, you can see that MSCI Brazil, gold, China, EU, even EMX China is really outpacing the S&P 500 right now. So, a lot of talk about tariffs, a lot of talk about how that's going to affect emerging markets, and some of the emerging markets and international stocks have finally started to do well, because as we've seen with Trump's tariffs that he imposed on Mexico and Canada, they were short-lived, and basically he wants to claim some sort of victory by imposing a tariff and then taking it away and getting some sort of trade deal that may have already been in effect, but that's just sort of his style. So I think it's a lot of talk and not a lot of action. And I think that the market's starting to realize that. If you want to turn to page 18, this is one thing that, we've talked about sort of ad nauseum for a while, but now the equity risk premium is actually negative. Okay, which just means that you're taking excess risk in stocks and not receiving the risk-weighted return that you would in bonds. So bonds are offering a more attractive risk-weighted return than stocks are right now in relation to the S&P 500. As you can see, the last time this was negative was basically in 2001, 2002. And it turned negative going into the dot-com obviously bubble of the late 1990s. Got as low as almost negative 300 basis points, which is pretty low. Page 19. Earnings revisions here. We're still looking at 12% growth for 2025, but as you can see, they're starting to trend downward in terms of what we thought they were going to be. And a lot of that has to do with the change in the Magnificent Seven, right? The 493 is finally starting to catch up, and the Magnificent Seven, which was had 40% earnings growth year over year, basically the last few years, now is expected to have high teens in terms of earnings growth. So there's not going to be as much earning growth in the Magnificent Seven. You've seen a lot of a change in leadership in terms of what the market is favoring right now with the Magnificent Seven and other asset classes as well. Page 22. A lot of bullish consensus on Wall Street, obviously, expecting about 10% earnings growth or 10% market growth. On the high end, we're more, I'd say, in the 6,380 range or 6,160 range. So we really think we're going to kind of be flat this year, maybe 3% growth. Page 23. One thing I want to point out, we kind of talked about this right-hand side. Credit spreads are extremely tight right now. Okay, they're not historically tight, but they're very, very tight. So one of the reasons we've been on the low end of high yield is because those credit spreads are very, very tight, and you can see the volatility of credit spreads is a lot less in investment grade, that light blue line on the bottom, than it is in high yield. So when we see a widening out of high yield, we certainly will start to add to that asset class in the pension. 31. Left-hand side, we talked about this a lot of times. You can just see the valuation dispersion between the two, all the different market participants and how high the U.S. is. I think it's 25 times forward earnings right now. The S&P 500 is, which is again in the 98th percentile of all forward returns. You just want to go to the next page too. Again, just a little deeper dive on the different types of asset classes that have done better. And you can see all international has done better than the S&P 500 year to date. Any questions about that? So, what we've seen is a change in leadership in the market. All right, Magnificent Seven has kind of stalled out. U.S. exceptionalism has kind of stalled out. Even small caps and mid caps, which are going up at least, but not as fast as I think people were expected. And I'd say the asset classes that people thought were going to be hit the hardest because of Trump's trade policies are actually doing pretty well because the valuations and the earnings growth there are actually much better than people expected. And just to kind of put things in perspective too, all right, Europe is cutting rates right now, okay? inflation has kind of been, kept under control there. Whereas here, obviously, the Fed is on pause, and the last inflation reading was much higher than people expected as well. So there's been a divergence there as well. And then also on the steepening of the yield curve, there's been a divergence there over the past few months as well. The 10-year at 4.55, the 6 months actually at 4.50 right now. So it's not the 2s10 spread, but you're seeing the short end of the curve kind of not have as much volatility to it as the Fed, decides to kind of go into a wait and see mode. And the 10-year has really come down from, it was 4.70, 4.80 just a few months ago down to 4.55. We're going to go to the performance report. Any questions about what's happening in the market here to start the year? No. Okay. So when we look at fiscal year to date here on page 4, this current fiscal year, we're up 677 gross of fees, 633 net of fees. We're now up 670 net of fees for the fiscal year versus 60/40 of 815. Year to date up 3% versus a 60/40 versus 313. As of yesterday. Next 12 months cash flow, lower right hand side, you can see it's going to be $676,054. Go to page 9.
Makes me feel better. We're using 5 and 10 years, so because we're closer to our IPS with the results than the 5 and 10 years, and we're in just 1 year. So that's good.
Yes, so longer periods of time, I think we had talked about this in the IPS memo last month.
Yeah.
When we look at the longer period of time, so like the 5 years and the 10 years, yes, we've lagged the benchmarks. There's no question about that. But have we done what we needed to do to satisfy the actual assumed rate of return? The answer is yes. And I know that, the preliminary results were kind of shared, with the board. Funded ratio did go up. And if you look at it on a market value basis versus the liability you have, you're now at 89% funded. Okay, that's not the way it's actually calculated, but just given where you are as of yesterday and what the liabilities are, you're moving in the right direction, and we've been moving in the right direction for quite some time now. Page 9. All right, left-hand side. We beat the benchmark 1 month. Yay. All right. Yay. That's so great. All right. 45 basis points over the IPS and basically 80 basis points over the 60/40. So this kind of just, shows the rotation. I think the benefit of being diversified and the benefits of, investing in things that have higher potential for return in the future, given where their valuations are. I think one of the things I talked about last month was, given where U.S. valuations are in the market right now, Bank of America did just a great chart of regression of multiples that you pay in the market and then actual 10-year returns. When you look at where we are today, the expected 10-year return is somewhere between 0 and 3%. Okay, so we're going to have, most likely there's not a lot of variance, there's a lot of fit to the line basically. So it'd have to be something that is completely out of the norm for the last 120 years of the market for us to see, 9 to 10% returns going forward, given where the valuations are. Page 11. One thing I did want to point out here, which is interesting because I know we've had a lot of discussion about, our underweight in large cap and our overweight to international and emerging markets and short-term bonds and things like that. One of the things I actually uncovered was when we look at the manager style, okay, which means that the managers that we actually employ, like, John Hancock and Aristotle and, the S&P 500 index that we have, the large cap style is closer to our target. It's around 29, 30%. Okay. But when we look at the underlying holdings, which is what this actually gets into, you can see we're, just above the minimum at 22, 24. And now we're above, we're at 17, almost 16.5%, sorry, of mid cap when our maximum is 9%. All right. And the reason is, all right, this is what's happened. This is sort of like the last 2-year phenomenon is mid caps in 2023 were classified as stocks with a market capitalization of 2 billion to 10 billion. Okay, 2 billion to 10 billion was a mid cap stock, and anything below 2 billion was a small cap stock. Because of how fast the market now has gone up, all right, small caps now are 2 to 10 billion, what mid caps used to be, and mid caps are 11 billion to 60 billion. So we have a lot of stocks that are in that 50 to 60 billion range that are being classified as mid caps that would have been large caps just 2 years ago. And that has to do with a lot of the Magnificent Seven, the fact that you have these now mega caps with trillions of market cap that have pushed all the market cap weightings up and up and up. So just want to make you aware of that. When we get to, maybe if you go to page 15, or sorry, 14. This is the managers here. You can see that, John Hancock has done better than the S&P 500 year to date. Siegel Bryan Hamill is doing better than the benchmark. Schroders and Lazard all beating their benchmarks. And, not for nothing, but I understand the arguments and things for, the international and the EM being a drag on the portfolio. But if you look back, on the time periods for the managers that we've hired relative to their benchmarks, especially, in this fiscal year and the last 12 months, they've done a very good job relative to their, your EM international benchmarks. You can see that. Any questions? So I know we're gonna have a discussion about the IPS and things like that, so we can get into that a little bit later, but any questions about the portfolio?
Is there a way we can compare our returns in fixed income and isolate that? It doesn't seem as though that information is here.
So it is. It's if you go on page 13. So that's page 13. The two middle lines here. Okay, so we have Boyd Watterson intermediate fixed income, and we have parametric short-term corporate bond ladder. Both are about $3 million. Okay, so we're kind of a little more barbell than we had been in the past. And you can see, again, being in the short-term corporate bond ladder over the last few years has been, extremely beneficial as opposed to intermediate term bonds. Now, and the intermediate term benchmark. Now, a lot of people are just like, well, fixed income is always lagging the benchmark. Why don't we just be the benchmark? Okay. Why don't we just buy the Barclays Aggregate Bond Index? Well, the problem with that is that the Barclays Aggregate Bond Index, okay, has a modified duration of somewhere between 8 and 9. Okay, which means that their average bond that they're holding basically has an 8 to 9 year maturity. And as you've seen, long-term bonds the rates have gone up, pretty significantly. If you had invested in the Barclays Aggregate Bond Index, okay, in 2021, you would still be down 15% on a, net basis. So you're not even at break even yet. So the fact that we've been in, these two managers, and, one of them basically is treading water with the intermediate term bond manager the last 3 years. And the other one's actually made, 164 the last 3 years and 429 in the last 12 months. We're doing much better than the overall Barclays Aggregate Bond Index. So.
Well, I'll ask the same question that you just answered in terms of the ladder. It seems to me we're trying awfully hard to get whatever we are. I think I saw somewhere we're 0.56 or point something minus.
Um, 0.56
minus return. Our bond returns are minus 0.56. I recall.
That's not what this is saying, so I don't know where you saw that information,
I
but.
don't either.
Let's see here, if we go to page. If you go to page 20. It just gives the duration of the portfolio and everything. So basically, we've been increasing duration. Okay, if you remember, we were under 2 years not that long ago. Now we're getting closer to 3 years of modified duration. Just go to the next page, upper right-hand side. And our yield to maturity is 5.25 now, all right? So it just means if we hold all of our bonds to maturity, which we are doing, we're gonna get 5.25 in terms of our bond portfolio. And we do have an actual unrealized gain in the portfolio now because we've, bought longer term bonds that have now started to finally make money because longer term yields have started to, come in. Let's see where you would have found
I
that
don't know.
number. Because if you look at, page 30, fixed income and prefers in the portfolio as an aggregate, last 12 months has made 5.04% versus the Bloomberg US aggregate at 2.07. So we've beaten the benchmark by 300 basis points. That's a lot in fixed income, just so you know. If you can beat the benchmark by 10 basis points in fixed income, that's a good amount. And then also last 3 years, up 245 versus down 152 per year. Last 5 years, up 217 versus down 0.6. So we've done the right thing in fixed income. I don't think there's any question about that. I mean, but I think being short term and now moving to a more, laddered or barbell approach has served us well on the fixed income side. Any other thoughts?
Questions, Leanne or Rowena?
I don't have anything.
I'm good too.
Okay. You want to bring up the wealth strategies analysis? So again, from the last few months, we've been talking about the investment policy statement memo and what we want to do to try to I'd say tweak the investment policy benchmark, investment policy statement to bring it more into line with some of the board members' preferences. And so we've done some asset allocation studies. I think we tried to show that diversification in international and emerging markets, even though the returns haven't been, what people probably expected the last 10 years, they provided a diversification benefit in terms of lowering the volatility. And so we wanted to kind of continue that thought. So if you want to go to page 4. So the wealth strategies analysis.
Okay.
Not sure if you have that there, but we can pull it up here, and it was part of the packet. So current scenario is just what we have actually in the portfolio as of today. All right. The middle scenario is Paul's suggestion to basically flip the allocation from emerging markets and international into mid cap and small cap. So mid cap is going to be a 10% target allocation, small cap is going to be a 10% allocation, international will be 7%, and EM will be 3%. All right. And then the right-hand side, all the way to the right, that one's just taking the midpoint of where we are today versus Paul's suggestion. So we're not going all the way to 10%. It'd be 8.5% each of small cap and mid cap, 8%, 8.5% they're international. I think it's 5.5% of emerging markets. So if you look on the bottom, okay, this gives the 30-year potential investment results. Okay, the 5th percentile means that we have the worst markets we could possibly have. Okay, that's the bottom 5% of markets that we get in. Since this is a spending portfolio, we would run out of money. okay? So if we have a terrible 30-year period, then something's gonna have to be figured out because that's, you know, we're not gonna be able to pay out the liabilities for the next 30 years. That's not likely, okay? Neither is the top 5%, the 95 percentile, okay? So you can see in the current scenario, 181 with the the small mid cap being 10% each, we get to 186 million. And then at the midpoint, we'd be at 182 million in change, right? The 50th percentile is the most likely. That's the average, right? So that takes the good and the bad. We're gonna have a lot of volatility over the next 30 years, you'd think. You can see that in the 50th percentile in the current scenario, we'd have just over 35 million. In the mid cap, we'd have just under 33 million, and in the midpoint, we'd have just over 33 million. Okay, so current scenario, you know, a little bit better than what we have in the other two scenarios. When we look on page 7, okay, the returns are not that much different, right? Like 0.1% away, right? So it's like, what's the difference between the three of these? So let's just choose one, no big deal. The standard deviation is what the difference really is. So you can see that the small mid cap at 10% each will have the highest standard deviation of the 3 different buckets. So that's something to kind of keep into consideration. And then if you go to page, where is the page 18, 19, I'm sorry. This is really gives you like, what are the kind of the risk parameters of the different types of portfolios. So value at risk is just like a measure of what would be the average worst loss over a 12-month period, all right? And for the current scenario, it's 2.6, and the mid cap would be 2.8, midpoint would be 2.7. Expected tail loss means that for the worst 5% of trails over a 24-month period, what would we expect to do? And you can see the numbers there. Worst trial would be the absolute, worst 24-month period that the portfolio could possibly see. So think of a 2008, global financial crisis type situation. And max drawdown is the lowest point that you would see over a 24-month period, okay? So that means within that 24-month period, what would be the lowest point that the portfolio would see? And you can see that is at, 12.2 for the current, 13.4 for the mid cap, and 12.7 for the midpoint. So trying to show what you're doing is actually okay. Understand that, there's changes that want to be warranted, but want to give you the information to make an informed decision about how you want to move forward. Leanne, any comments or?
Yes. So thank you, Kevin, for pulling this all together. And it's nice to kind of look at the 3 different scenarios where we are today. Something that's a little bit more large cap centric and then the midpoint. And obviously the current scenario, it has the best risk return parameters, but be reminded that this is over a 30-year period. So things tend to smooth out. And I personally found that all the scenarios were fairly close. Obviously, if you're just going to pick the best one, we'd pick the current scenario. But if there was, a short-term desire to, move the portfolio to that midpoint scenario or something like that, certainly that isn't going to hurt anything either. So I think that we have a little room to maneuver here, if that's what the board chooses, but all else being equal, this report tells us that we should stay with the current scenario as is.
Comments, questions? Paul, what do you think?
Well, just seen a very scientific approach.
Yeah.
My approach, of course, is seat of the pants. So,
I wouldn't say seat of the pants, I would say gut. Based on many years of experience.
Many years of experience. You know, I think we just saw a good example of what can happen in a very short-term basis, on a very short-term basis since the election, and peace being breaking out in the European markets. I think if nothing else, Trump has accomplished that. At least of some belief that it's possible, and we certainly see it in the returns. The returns have been terrific on the for the international markets, and far outstripped what we've seen here domestically. But that's a 4 or 5 month period. My own personal view is I don't like the euro, so I've got a bias. I think that I don't think that the whole concept makes sense. So, you know, I'm not in favor of investing in something I don't believe in. So,
And which market was that? What?
the euro.
Oh.
The different European stocks, whether it's France or Germany or whatever. So I think there is a developed market, and I think we're likely to outperform them over time. The figures don't support that, so we disagree.
I think, you know, to your point though, I just think that these things go in cycles is really what it is.
Yeah.
And we've been in a cycle of US exceptionalism for the last 15 years. You know, when we came out of the recession after the tech bubble, right? A lot of people thought that the US was going to gain its footing again, and small caps did very, very well. Large caps took a long time to get back, especially the NASDAQ, right? But EM and international actually did extremely well until the financial collapse of 2008, 2009. And then you saw that in the 80s as well, right? There was a lot of international and emerging market outperformance there before we got to 1990, 1991 when the US did well. So I think the market has shown us that over longer periods of time, there's different regions, just like there's different managers, just like there's different asset classes that are the leader and are the dog. And they change over time, depending on what the market decides to favor. It seems, at least to me, in my experience, that valuations over the past 2 years have not mattered. And I showed you that chart, maybe it was like, I think it was either last month or the month before, which basically said 20 to 25% of the return over the last 2 years has just been from multiple expansion. It's not because the earnings are great, it's just because people are willing to pay higher prices for things. And what history has shown us is that earnings growth does come. It does come. It comes usually like decades later though. So people get way too optimistic about things, and the earnings growth that they were expecting, it's not that it's not going to happen, just what they were expecting, does not materialize within a period where investors will be patient for it. And then valuations start to matter, and that's when you see things start to either, you know, come in, rotate, shift, whatever it may be. And to me, yes, it's been a short, very short time period, but it seems to me that valuations are starting to matter on some level. And that's why the US is kind of stalled out here. And then again, yes, international is lagged. Yes, EM is lagged. Thank goodness we weren't in the indexes. We would have been even worse off. So the managers we've actually hired for those asset classes have done a good job. They have, and the numbers show that. I think my major concern about putting small and mid cap to 10% each is not that that's not a viable strategy, because it is. It's that we will now increase the risk of our US concentration. That's what we'll do. So we'll be less diversified. Okay, we'll be more diversified within the US, we'll be less diversified from a global investing perspective. That's my biggest concern there.
all I can say is I'll take the other side. I just think that the US is, in a much stronger position for growth than most of the markets in the world. So.
That's fine to have that opinion,
Right.
but when we're looking at the pension plan, I don't wanna make bets, I wanna try to make, rational decisions about where we need to be allocated and how do we need to have cash to pay the pension benefits, because in my experience, the things that really matter are, paying the pension benefits and growing the funded ratio so that the town contribution can be less going forward. And I think we've accomplished those two things over the past, decades. So could we have tweaked things better? Absolutely, no question. I mean, the numbers don't lie for that. We could have done better. But did we fail? Absolutely not.
That's good information. So I guess back to sort of the memo that Leanne put out in January. What, if any, change do we want to make? Do we want to make a change to the range and the large cap? And or do anything with the mid and the small cap? Do we want to do nothing? What are the general feeling?
It seems to me that now is a really bad time to make any kind of change, and I'm relying on the experts that we hire to fulfill our fiduciary responsibility. So I'd go for no change.
Okay,
I like the diversification that we have. It does level, right, the volatility, so I say no change.
others? Paul, what do you think? You want to make some changes?
No, basically, I like the diversification we have, except I would like a little different weighting towards being nationals. The thing I was most concerned about was the 22% weighting in large cap. And I thought that we should have a tighter target. I think we're 22%, and we could get it down to 21%. And Kevin has raised an interesting point on that there's been a shift within the indices.
Yeah,
But I still want to make sure that we've got it tight enough so that we're favoring the large cap US stocks. Because that's where I believe the success is likely to come.
Where we're at, clearly, I think we're still doing that. We made no change, we're still favoring the US large cap,
Yeah,
just not as much.
well, I just want to tighten it up so it's not 22%, it's 30%, whatever it is, 35%.
Target's 34.
Well, that would be under the change of the target of 34.
The current strategy.
Yeah, we go from 29 to 39, target 34.
Right. Yeah, versus a 22.
Yeah.
Yeah.
Kevin's tired of seeing this.
No, I brought it actually last, you weren't here. I brought this last,
Oh, okay.
yeah. And the neat thing that I thought was neat was, I don't know, can I say one just for a second? We had kind of the same thing. Yeah, we did this cool thing. I brought it like last time with the market perspectives. And you can see, yes, over the 10 years, large cap, did the best, right? But this balanced, okay, which is this orange line, you can see right in the middle, basically the whole time, right? Balance. So it's not up, down, up, down, up, down, up, down, up, down. And then over the 10 years, you've got, the different asset classes. The balance stays close to the middle. And that's the benefit of diversification, in my experience, is that you're not taking, an overweighting in a certain asset class that can help or hurt you and has a lot of volatility to it. Because as you can see, the stocks that do well one year are terrible the next year. And then maybe they're good for another 2 years and then they're terrible again. And then they're on the bottom for 2 years and then on the top. So it's like, it's very hard to predict what these things are. But if you have a balanced and diversified portfolio, you're gonna stay in that middle range. And that to me is, there's a safety in that, I guess you could say. And when I think about just the pension, that's the way that I prefer to manage the pension, would be with a focus on diversification and safety as opposed to volatility. Understanding that the board may feel different.
Leanne, I think you already chimed in, but what are your thoughts?
I hear what Paul is saying. In the short term, if we were to change it to, I wouldn't go all the way to that, I would steer more towards that middle range. There would be no harm to do that. I do not feel, but I'm comfortable with where we are now. So I could go either way to the mid-range allocation or stay with where we are now. That's how I feel.
How would the mid-range allocation affect I'm looking at our little chart that shows maximum, minimum, and what it's supposed to be.
So
I'm not clear as to what the potential revision would be.
if we go to page 5 on the wealth strategy analysis. This gives you the allocations for all the different asset classes. So she'll just pull up in a second here. The net of it is that this is just the targets. So it wouldn't be the ranges. The ranges would have basically, they're usually within 20% up, 20% down.
Yep.
It's sort of like kind of the range. 20% of the target. So like it's 8% if it's 1.6 or 1.5 up.
Yep.
Okay. So the mid here, so you can see the current scenario, it just has this is our actual underlying holdings. So this is not the targets. The targets you can see on the performance report there right in front of you. SMID cap, 10% each. This would be the targets. Okay, so the cash would be 4, US equities would be 54, large cap would be, large cap value and large cap would be 34%. So 34% would be our target. 10% mid cap, 10% in small cap, 7% in international equities, 30% in emerging markets, 32% in fixed income, 10% in high yield. All right. On the right hand side, then you have, large cap still being at 34, but mid cap would be 8.5, small cap would be 6.5, international would be 8.5, and emerging would be 6.5. So that's the target. And then we have basically a 20%-ish standard deviation around that in terms of where our allocation can be.
Kevin, I have a question. When you ran this scenario, under current scenario, you used our actual holdings as opposed to our actual allocation?
Actual holdings, yes, correct. Yep.
So I wonder if that would have made a difference because the other ones were run as portfolio targets, and the current scenario was run as actual positions.
So I could certainly do that.
Well, I'm not asking, I'm just making sure that everybody understands that because, I can't see the screen too well. It's kind of tiny on my computer, but, we have, small cap, is at, 3.8 versus the 10% and mid cap is 3.4 versus the 10%. So we are actually, less weighted. I think, I'm not sure, actually, I can't, there's too many numbers here for me to contemplate what the differences would be. So my question is, would the EM SMID midpoint be a little bit closer to what we actually are at present? If we had run our targets.
Let's see. That's a good question.
We have 9.6% in emerging markets versus
6.5.
6.5. So I'm just curious if this makes Paul's point.
So where we'd be overweight relative to the SMID would be international is right around there. International is, is 10% basically. And again, I think too, this is kind of bringing up the current scenario is by style, okay? So, our actual holdings are just under 10% of international and 8.5 of emerging, which are, below our targets of 10% currently, right? Small cap, we're at 6%. So closer to the midpoint. Emerging markets close to the midpoint probably. Mid cap is above that. Mid cap is closer to like the 10% because again we're the difference in the markets have caused a shift towards mid cap, and then high yield a little bit underweight. But yeah, I think it's a valid point. We are probably closer to the EM SMID midpoint than you would be led to believe.
But that's because we have the ranges, and that's what you guys do.
And so the other point would be, even if we went to the EM SMID midpoint, we could still end up with the current scenario as is anyway. So,
Possibly, yeah.
Yeah, I guess my feeling is, I've been pounding the drum a little bit on the large cap, we need more and more of that. And now if we change that, we may be getting we're gonna be late to the dance. A little bit. So I guess I'm comfortable that we've done our job, we've looked at this stuff, we gotta rely on our professionals, and there's some good information you gave us today. That I'm comfortable that we've looked at it and it makes some sense, and we'll keep looking at it as we go forward. But for now, we don't need to make any changes.
At the risk of stating the obvious, isn't it within the ranges? It's your job to put us within the ranges.
Yeah, we've been on the low end
And veer towards large cap if you feel it benefits us, which may go above the midpoint at times.
Correct.
Carol, I have a question. Is the pension board, the IPS revisions, do we keep it as is, or in the memo, we had tightened up some of the ranges and moved some cash around? So there was a recommendation there to do a little bit of tweaking, which I support, but I didn't know if you wanted to just leave the.
You support the tweaking.
You support the tweaking, okay.
Yeah. So the large cap goes from the minimum of 21 to 29%.
Yep.
Target 34. And then the only other thing was the cash on the target of 4%.
So
versus 7.
Yeah.
So what we will do then is next.
The one question we had, and maybe it's not part of this here, but also was, do we want to do anything as far as changing the assumed rate of return when we get to the actuarial stuff? I guess that could be next month's discussion, whatever.
Exactly. I was going to say, now that we have this piece down, next month, we're going to speak with the actuary, and then in April, we can bring the IPS revisions for the board's vote, which will include both pieces.
Okay. So bring the memo and everything to vote on for next month. That makes sense to everyone?
We're not changing the minimum maximum yet. We are gonna do that next month.
Correct.
Actually, I think you're recommending we do it in 2 months after we hear from the actuary next month.
Right. So we'll incorporate the IPS, the actual document will come forward to you in April with these asset allocation range changes. And if you do make any changes with the assumed rate or anything with the actuary, that's also listed in the IPS. We'll make whatever change you decide on at that point, and then in April, everything will be decided, and then you can vote on the IPS as a whole.
That'll be April, 2 months out.
Right.
Everyone okay with that?
Yes.
Makes sense? Okay. Okay, good information. Thank you very much.
Thank you for going that effort. Seeing the difference between the various markets and the impacts is very helpful.
Okay, Leanne, anything else?
On my report, I have a couple things.
Yep.
So last month, it was asked if we had, an overview of both of the pension plans as far as the cash flows and expenses. So, I did include them in the package, and just very quickly for the fire department pension plan, and you should have those in your packages. We actually had a net outflow of $20,000. So we had, an employer contribution of 180, and we had an outflow of pension plan payments of 169,000. And then, of course, we paid our actuary. So all of that came out to about even cash flows. So in this portfolio, we are dependent upon, obviously, market gains to help us move forward, increasing our funded ratio. And then in the town's pension plan, the overall outflow is 1.1 million, and we know this is a cash flow negative plan, and this document shows that. We had employer contributions of 851,000. We had employee contributions of 264,000. So, over $1 million came into the portfolio, and just under $2 million went out in benefit payments. And of course, we had actuary and other expenses. So, net outflow 1.1 million for the defined benefit pension plan. And that's fiscal year 24. So that's July 1, 23 to June 30, 24. So I think that's as expected. I didn't see anything surprising there. And then I also have some highlights of the valuations, but does anybody have any questions on those two year-end reports before I move forward?
So is that, I guess that has to do with the age of the plan too, right? When you start getting a net negative like that.
Yeah.
Right? So we have a $30 million balance. If we're net negative for the next 30 years, that's probably kind of okay, because the plan kind of ends at that point almost, except for we'll be funding the police.
Yeah,
and-
please.
Is that,
That is
So,
correct.
so the actuarial,
Conceptually
yeah, when
correct?
you get the actuarial report, it'll show you, I think it's the next 10 or 20 years, I can't remember exactly, but what the actual expected plan balance is gonna be, net cash flows, expected town contributions, expected employee contributions, et cetera.
Right.
And that's what we use for the cash flow study. So even though the plan will be paying and paying and paying, if we can get most of that from dividends, and then we get obviously growth in the market, that's what's gonna kind of offset that, so.
no, I get that. I mean, when you hear it's $1 million negative, it's kind of a scary number, right? I mean, no?
Well, no, because didn't the plan throw off more than $1 million?
Yeah, right.
Didn't we generate like $2 million?
No, right.
Well, I mean, it's almost 700,000 just from cash flow,
Right.
and then yes, from the performance.
And that was contributions only, right?
Yeah.
That's just,
Yeah, that doesn't show the investment.
yeah, right,
Just
right.
I would think we need more.
Yeah.
700,000.
Yeah, which is,
Makes
Yeah.
up the shortfall almost
sure does,
entirely.
and,
I don't think we eat into the principal at all. in
right,
this
right,
area.
and the point is not to have $30 million in 30 years, because then you're just wasting taxpayer dollars essentially,
Mhm.
because it's way overfunded, so.
But
No, I get what you're saying. Yeah.
I was asking, I mean, if you were concerned, I was
No, you're
concerned, I
right,
thought that was like,
you're
this is
100%
great.
right. That, Leanne, what Leanne pointed out is the actual contributions, not everything we're earning, versus what we're paying out.
Right, there's three pieces of flows that go into a pension plan. Obviously, the market appreciation or depreciation, that is not included in this report. All this report includes is real dollars that are actually being moved to pay expenses and to receive cash flows from employees and the employer. So, and that's what shows up in our audited financials as well. So this is a little bit of an accounting report as opposed to what you're typically used to looking at. Okay, so the other two things I wanted to give you a sneak peek at what Becky from Milliman is going to be discussing next month, so that you have a chance to mill it about and formulate any questions for her that you might be interested in asking. I think the first thing that I was very surprised at when I got these results from Becky was that she said she does not recommend changing the discount rate. It's now 6.75. And then I'll just talk about the, actually the town plan first, and then I'll move on to the, fire department. So she does not recommend that. She thinks that we're fine. And she can elaborate on that when she comes in. But so this plan also includes, there was some changes to the negotiated in the collective bargaining agreement for the police department. And those did increase the cost of our actuarially determined employer contribution. All else being equal, as we had said, we're starting to see the actuarially defined contribution decrease over time, and it would have gone from 753,000 to 750,000, slight decrease. But now it's going to go up to 820,000. We have budgeted appropriately, so that will be fully covered in our budget for the next fiscal year. And it does include the changes of the police department. Our funded ratio is going to go down slightly from 85.2 to 84.4 because of the change in benefits that we're giving our police officers. So it's very neutral. She did discuss some potential baseline changes that we may want to consider, like the level of inflation, or some other things, some of the demographic changes. But she said there's really not much. So I think it's going to be pretty close to this. But she'll come back with some more options when we meet next month. In terms of the fire department plan, again, that rate we already had at 6.5%. This is an off year. Normally we wouldn't have done the fire department this year, but the fact of because we did the cost of living adjustment, we're going to do the fire department 3 years in a row. So she actually thought maybe we should increase the interest rate. And I said, why don't we keep it on? Well, this is my opinion. You all make the choice, but I thought maybe we should make major changes in the fire department plan when we get to our biannual evaluations to keep us on track. But for 6.5%, you all know about the cost of living adjustments that were made for the firefighters. That did increase our actually determined contribution from this year. It's just 195. All else being equal, it would have gone up to 209. And with the officer incentives, it's going to go up to 271,000. We did get this information in time to budget appropriately, unless, of course, the pension board makes some changes that would change that contribution next month. The funded ratio did go down from 55% to 49%. Not unusual when you change the benefits, but as you saw in that other report, we're really close from a cash flow perspective. In other words, everything coming in equals about what's going out. So we are counting on market gains to increase, our funded ratio as we go forward. And that looks perfectly normal to me as well, to expect that we will have those cash flows equal and want to have the market gains increase over time to increase our funded ratio. So nothing unusual that I saw in this one either, but you do have the numbers in front of you. If anybody wants me to email a question to Becky or have her focus on anything, you think about it today or even after the fact, just let me know and I'll make sure that she's prepared to discuss that with you. And that's all I have for today.
Can I just ask a question, I think more Carl, with respect to these new models? What, the changes to the pension plans that were negotiated, was that just to make the position more attractive because of the other issues we're having, or did we kind of shift? We got better pension, but we changed over time. I don't know.
A little bit of a better pension. If you're there, used to be 25 years and out, and now if you are there for 23 years, so we went down 2 years. In addition to that, there's a 12% kicker. So, if your last 3 years are 100,000, your pension, Leanne, correct me if I'm not phrasing this correctly, your pension can be based off 112,000.
Overtime to cut, to, have made 12,000 extra. Correct.
You know, we negotiated this with Becky's help, to get some ideas and looking at other plans in the area. So our pension is, I think Kevin, Leanne can also attest to this, is not a rich pension at all, okay? Let's be, which is fine. I have no problem with that. Public safety, we never went to a DC, we stayed in the DB. Towns are going back to a DB, the towns that, some towns I know, or there's now discussion at the state level with the municipal employee retirement system, to have a MERS 2, to make it easier for towns who might be losing other town workers, like building officials, fire marshals, to go into more of a state plan that has a defined benefit plan, because I know, believe me, there's actually a law proposed, and they did this last year too, a bill proposed up there, to mandate that towns go into it. Now, I don't think it's gonna go anywhere. The first month of the legislative session is crazy time. The bills that, you have to tell people what time the movie actually starts and not the trailers, I mean, stuff that's not gonna happen. I mean, that was actually, you saw that, right? Everybody saw that?
I did.
Martin Looney, no surprise there, proposed that. So, we did make some changes. They were relatively modest, and it requires an officer to stay there for 23 years, which affects our actually required contribution, but may not actually hit the pension plan, right?
Yeah.
Because they move. Yes, those were two of the changes that we made to make the position a little bit more attractive. We didn't change the multiplier. There's no COLA. So they were relatively conservative changes to the plan that didn't really impact, I mean, it did, but didn't throw the plan out of whack. And in fact, we only had to budget a little bit more money for the fire department plan, not even for the town pension plan with the changes. So that's good. So
And if they make the position more attractive, even just facially, that's
it.
good.
Yeah, that's the idea.
Great, thank you.
Other thoughts? Anything else? Yeah, not familiar with any other old business or new business?
So we do have the 457, 401
Okay.
stuff that we wanted to just discuss. Yeah, quickly.
This, we can make it, pretty quick.
I'm sure we've all read the 94 pages.
Yes, it is very extensive.
Any idea what document I'm looking for?
You did.
I got that far, that I saw the 94 pages. Oh,
Okay, so, on the overview, I was just gonna touch over at the end of 2024. The total account balance for the 401A was 2.143 million. The account balance for the 457B was 4.742 million. That makes the combined total, asset totals, account totals for the defined contribution plans at the end of 2024 is 6.886 million. If you look at the participants for the 401A, again, Jen and I look at this, we have 79 eligible, 77 contributing. There can be a reason for those too. Either late starts or people that are in the system, but their hours have gone below what it is required to earn their contribution of 5%. And then of course the town 5% match. And then in the 457, we have 106 participants that are eligible, 81 that are contributing. And if you go a couple lines down, you can see employed with a balance. That's actually 92 people are employed with a balance.
So, where there are more people in the system, they're maybe not contributing this quarter or whatever, but good to have them there. And then the average of all contributing is 4.48%. Again, for those that are in the 401A, that's a pretty good overall contribution rate, and that number has gone up. The second page, we just look at the numbers over time, and it's just it's interesting to note that back from end of September 2021, the combined value is 3.7 million. And now at the end of 2024, we're at 6.88 million. So just to see those, numbers raising over time, of course, there are withdrawals, people who are taking distributions, but obviously lots of contributions into it. For the performance report, really just 3 pages to highlight. One is the overall asset allocation people are choosing to invest in, really well diversified. We can see that target rate, the target funds at 37%. So over a third of the allocation is to that target date, which, it puts people on the path to growing more conservative the closer they get to retirement. It is a very good choice for participants. And then just highlight all the criteria that we use to monitor all of the funds that are that we offer to the participants. Quite a rigorous monitoring criteria. And then as we discussed last time, there are 2 funds that we decided to change, and that will be enacted actually in this quarter, first quarter of 2025. And we'll see that being reflected on the next report. That's all I have.
I love it. I love that there's almost $7 million between the 401A and the 457. That's pretty remarkable.
That's good.
Considering, we started the DC plan in 2017 and added contribution, and I love it. I mean, it's been, I'm in it. It's great.
And I just want to point out too, the last time we were here, when we did the education session, I think, there's or something like that, like, people actually showed up, asked great questions. We had a few follow-on meetings and things like that today, so.
I heard that update. I was wondering why we've had such low participation. What did we do differently to end up with more people last time?
Food.
We had food.
Food.
There you go.
I think maybe timing. In the past, we've done them in the fall. And I think there's something about starting a new year and people say, you know what, this is something I should be thinking about
Yeah.
for the beginning of the year.
Yeah.
So I think that was also helpful. I will say, Janet, thank you for sending out the note to the board about the increased participation. But in 2025, we have run 3 financial plans, 3 brand new financial plans, and we have another couple that are in the works. So people are kind of gathering their materials and getting that to us, and we're running plans for people. So that's also, fun and good.
Cool, I didn't know we offered that as well.
Is that something that's part of the plan and they don't pay for that?
Correct. Yep, all the service charges. And then I think the word of mouth helps, one person gets a really good plan and they're making good decisions, and then they tell their colleagues, and so, sometimes it takes a little bit of time to kind of get that word of mouth, but it's, it's good.
It's wonderful. Anything else, anyone? Motion for adjournment?
So moved.
Okay. See you next month.